You want to buy a cargo ship, not sail it, own it. Collect the charter income, build the portfolio, join the quiet network of families and funds that control what moves between continents. The fantasy is reasonable. Here is what the business actually looks like up close. A modern container vessel costs $50 to $150 million. The company whose logo is painted on the hull probably does not own it. In global shipping, ownership and operation are separate businesses run by separate companies with separate risk profiles. This arrangement exists for tax reasons, liability reasons, financing reasons, labor cost reasons, and a few other reasons that accumulated over decades and never got cleaned up because they were too profitable to question. Anyone who gives you one clean explanation for why the structure exists is leaving most of it out. A container ship is 40,000 tons of steel welded into a hull engineered to flex in open ocean without fracturing under load. A two-stroke marine engine taller than a four-story building, burning around 150 tons of fuel per day at cruising speed. The largest vessels today carry over 24,000 containers, stacked 9 high above deck and 8 below the waterline. Built for a 25-year operational life, maintained across continuous cycles of flag state inspections, classification society audits, and port state control reviews. Miss one at the wrong moment and the vessel gets detained. It sits in port burning daily operating costs while paperwork gets sorted. The ship is not moving. The bills are. The price depends on steel costs at the time of order, engine specification, shipyard capacity, and where global shipping demand is sitting when you sign the contract. The major yards are in China and South Korea. Lead times run 2 to 3 years. You're committing to a $100 million asset that arrives into a market you cannot predict. Every new build order is partly a bet on conditions 2 years out, placed by people who have been wrong about 2-year predictions before and will be again. Shipping prices move like volatile stocks. During the 2008 financial crisis, some vessel values dropped 40% in a single year. Ships that cost $100 million to build were worth $60 million before they moved a single container. The demand had disappeared. The steel had not. Owners who had financed at peak valuations found themselves with collateral worth less than the debt. Banks that had been enthusiastic partners 18 months earlier stopped returning calls. Some owners survived, many did not. In this industry, experience is mostly just the memory of previous disasters and the scar tissue from not having been wiped out by them. The three main players, shipbuilders, operators, owners, are almost always different companies. Maersk and MSC operate thousands of vessels with their names on the hulls. They do not own all of them. Many large operators deliberately own as few ships as possible. If demand drops, they let the charters expire and return the vessels. The operator stays lean. The owner absorbs the hit. That transfer of risk is priced into the charter rate, theoretically. In practice, the pricing is often wrong in one direction or the other, and somebody ends up holding the worst side of the deal for years. So who actually holds the deed to that $150 million piece of steel? The most specific answer is the Greek shipping families. Athens controls roughly 20% of the world's entire merchant fleet. The offices are mostly in Piraeus, the port district south of the city, in buildings that are not particularly impressive given what is being managed inside them. Shipping is not a flashy business at the ownership level. It is analysts watching Baltic Exchange indices, lawyers reviewing charter parties line by line, and executives on the phone with banks at inconvenient hours discussing collateral valuations on assets currently somewhere in the South China Sea. The families have been doing this for generations. The strategy, described simply, is to buy when everyone else is selling and charter aggressively when rates recover. What gets left out of that description is how decisions actually get made. Families where the founder died and left the fleet to children who disagreed about whether to sell. Owners who knew intellectually they should exit and could not bring themselves to do it because the number felt insulting. Banks that froze credit in 2009 to owners who had never missed a payment because the banks themselves were under pressure and shipping was an easy line to cut. Vessels held for 5 years through catastrophic rate environments because selling at that price felt psychologically impossible. And then the market recovered and the stubbornness got retroactively relabeled as vision. Luck and judgment are hard to separate after the fact. Some families survived because they were conservative in years when conservatism looked like cowardice. Some survived because a crisis turned out shorter than expected. A few survived because a competitor failed first and distressed assets landed in their lap at the right moment. The history of Greek shipping is full of people who made correct decisions for wrong reasons and wrong decisions that happened to work out anyway. The ones who tell the most coherent stories about their own success are not always the ones who understood it best at the time. Outside Greece, a significant portion of the global fleet passed through German KG funds in the 1990s and 2000s. Retail investors, teachers, engineers, civil servants, pooled savings to buy individual vessels as tax-advantaged investments. The pitch was that global trade would keep growing and shipping would keep generating returns. After 2008, many of those funds went bankrupt. The investors lost their money, not trading money, retirement money. The ships went to auction, got picked up at distressed prices by other owners, and kept sailing under new flags. The investors had no further involvement in the industry. The vessels did not notice. There are also Japanese leasing conglomerates that hold ships as balance sheet depreciation assets, and private equity firms in London and New York that evaluate maritime investments the way they evaluate anything else. Return profile, downside scenario, exit timeline. They do not visit ports. The investment thesis does not require it. These owners rent vessels. 3 structures govern how that works. A time charter is a fixed daily rate for a fixed period. $40,000 a day for 3 years, for example. The owner handles maintenance, insurance, and crew. The operator handles fuel, ports, and cargo logistics. Predictable income, limited upside. If the market doubles 6 months after you sign, you watch it from the outside and think about the conversation where you decided 3 years felt like the right term. A bareboat charter reduces owner involvement to almost nothing. The operator takes the hull and handles everything: crew, insurance, maintenance, fuel. Lower rate, no operational decisions. Some owners prefer this. The money arrives monthly. The phone does not ring. The spot market is where rates move freely, voyage by voyage, responding immediately to whatever is happening in the world. In March 2021, the Ever Given grounded across the Suez Canal and blocked one of the world's primary shipping corridors for 6 days. Spot rates moved within hours. Vessels chartering at $15,000 a day were suddenly commanding $150,000. Owners with available tonnage made more money in several months than in the preceding several years. The disruption that paralyzed global supply chains was, for a specific group of asset holders, an extraordinary windfall. By 2023, rates had fallen 70% as supply chains normalized. Some owners who had expanded aggressively into the boom were over-leveraged on the way down. A few of them had given interviews during the boom about their disciplined approach to cycle management. The standard acquisition structure is 30% equity and 70% bank debt, with the vessel as collateral. Each ship sits inside its own shell company, usually registered in Liberia, the Marshall Islands, or Panama. One entity, one vessel. If that ship defaults on its debt or causes an environmental incident, the liability stays legally contained within that single company. The rest of the fleet is unreachable. The structure is used by virtually everyone in the industry and has been for decades. It is not a loophole. It is the architecture. It holds until the market drops sharply enough. Borrow $70 million against a $100 million ship. Values fall to $50 million. The collateral is worth less than the loan. The bank issues a margin call, demanding additional security or partial repayment. If the owner cannot provide it, the bank moves on the vessel. The crew sometimes finds out the ship has changed hands while they are at sea. Not always, but it happens. A notification through the management company, a new flag, a different port of registry appearing in the paperwork. The people operating the asset are the last to know about the transaction that transferred it. Environmental regulation is the current version of this pressure. New emissions mandates are forcing scrubbers, engine retrofits, and fuel system modifications across the global fleet. The cost runs to millions per vessel on timelines set by regulators who are not carrying the capital burden. The International Maritime Organization's decarbonization targets require the industry to cut emissions by at least 40% by 2030 compared to 2008 levels and reach net zero by 2050. The technology to achieve those targets at scale does not fully exist yet. Owners are spending now on compliance infrastructure for a regulatory pathway that is still being written. The deeper problem is the fuel bet. Order a ship today built for liquefied natural gas, and in 10 years the standard may have moved to green methanol or ammonia. The vessel becomes expensive to operate, restricted in certain ports, and impossible to sell at a price reflecting its remaining operational life. The investment community calls this stranded asset risk. In shipping, it looks like a $100 million vessel that cannot enter major ports after 2035 without costly modifications that may not be technically feasible. Owners are making 30-year commitments on fuel technology based on projections about regulatory frameworks that will be determined by governments not yet elected. Some of those bets will be catastrophically wrong. Nobody currently knows which ones. At the end of its operational life, a ship is sailed one final time to a breaking beach. Along in India handles the largest volume. The vessel is run aground at high tide and dismantled by hand over several months. Workers cut through the hull section by section with torches, working backward from the bow. The steel gets sorted by grade, loaded onto trucks and driven to mills. The owner receives payment by the ton for the scrap weight. A large container ship returns around $15 million at current prices. That number is always there regardless of what the charter market did over 25 years or whether the owner made money. The beach receives everything the same way. Profitable voyages and failed companies end up in the same place at the same price. For people who stay in this industry long enough and avoid fatal debt mistakes, the returns compound over time. The families with the largest portfolios built them across generations, through periods when owning ships was not an obvious idea to anyone outside the industry. They bought during crises when banks had stopped lending and other buyers had disappeared. They sat on vessels through years when income barely covered costs. They were not always confident they were right. Some of them were simply wrong for long enough that the market eventually moved in their direction, and afterward the story got cleaned up into something that sounded like strategy. The sea does not distinguish between the two. Most people who enter this business leave before any of that happens.